Hi, everyone. This is Matt DeLorenzo, Chief Investment Officer at United Asset Strategies. We're here for our October 2024 investment webinar. And as usual, we'll be taking you through a recap of the previous quarter and our outlook for what's to come. But of course, this time we can't ignore the fact that elections are next week and underway already. So this time we'll be giving a little bit more detail on policy, both monetary and fiscal. So to start us off, I'll turn it over to Jiorden for a recap of the previous quarter.
Thanks, Matt. So markets rose again in the third quarter, aided by an economy that continues to thread the needle between cooling inflation but resilient economic growth. And as seen in Exhibit 1, the stock market, as measured by the S&P 500, has returned about 22% year to date through the end of the third quarter, adding about 5% or so in the third quarter specifically. And as anticipated, the onset of a new rate cutting cycle alongside a resilient economy was a rising tide that lifted all boats. It was a bit of a departure from the first half of the year where we saw a narrow breath. The average stock, as measured by the S&P 500 equal weight, returned 9% during the third quarter, with about 2/3 of S&P 500 constituents outperforming the index. We also saw the non-magnificent seven parts of the market, small and mid cap and value stocks, outperform their magnificent seven, large cap, and growth counterparts, representing a bit of a change in leadership. It's also worth noting that bonds were up for the quarter, as seen in the 5% return for the Bloomberg US Ag, with treasuries firmer and the yield curve steepening. Now, through the end of the year, we expect the markets to be focused on the upcoming election, the economy, along with its implications for interest rates. And as we've discussed throughout the year so far, market returns in an election year have historically been pretty healthy. Now, moving over to Exhibit 2 really quickly, election years have historically generated a median 11% return, which ranks second out of the 4-year election cycle, with a particular tendency to be strong post-election as uncertainty is removed, and that's irrespective of the election outcome. But with equity markets already up 20% year to date, we would understand if there's some skepticism as it relates to the typical year-end seasonal pattern. That's why here we also wanted to show that past years of similar strength, those other green lines, still had, similarly ended the year higher post-election. So to continue this conversation, at this point, I'll turn it over to Tom to touch on the economy.
Thanks, Jiorden. As Jiorden said, a critical component to the market's performance is the economic outlook. And I think we would agree that right now the market consensus is for a soft landing. And what that means is the Federal Reserve had been raising rates to slow the economy and to cool inflation. And the goal of a soft landing is to slow it enough that it causes moderating inflation without moving the economy into recession. And right now, that looks to be the case. If you look at on this Exhibit 4 in the first chart, you see real GDP growth. You see it has slowed a bit from the 2023 level of 2.9%, closer to the mid 2.5%. Actually, the third quarter number came out this week at 2.8%. So still very healthy. While the manufacturing side of the economy continues to be very weak, it's the consumer side that continues to drive the economy. And that makes up 65% of GDP. So that's really important. We're seeing it. Retail sales have been strong. Consumer confidence has been strong. And that really is reflective of two different things. One is what you see in the middle graph, which is the unemployment rate. You can see the unemployment rate remains relatively low at about 4.1% versus a historical average of closer to 6%. So as long as people are employed, they continue to spend money. And in addition to that, we're seeing a moderation in inflation, as you see on the right side of this graphic, where PCE inflation from 2022 at 6.6% down to 3.8% in 23 and continues to come down here in 24. So we are seeing what looks like the orchestration of a soft landing in the economy, which is important. But what really matters here is how do we see monetary policy as a result of these figures. So I'll turn that to Matt to discuss in more detail.
Thank you, Tom. So everybody knows we had a 50 basis point rate cut from the Fed at the most recent meeting. So it was a big rate cut, and it was the first rate cut, so it's very important. But we do think it's very important to look a little bit deeper than that. So if you look at this slide here, on the left, it really tries to map out various scenarios of where the Fed fund rates not only is, but where it can go as the cutting cycle proceeds. So right in the middle, you can see the green line, and that's basically the Fed's baseline expectation, assuming that the economy stays fairly strong and inflation dissipates. So you can see there, they already cut 50 and they're anticipated to come down more over the course of the year. Compare that to the yellow line, which is the market. So the market has been behind the Fed, ahead of the Fed, and that's something that's constantly moving around, and that's impacting bond yields, particularly short-term bond yields. But what's interesting about what we have put together here is what historically has happened when the Fed has started a rate cutting cycle really depends on whether or not we have a recession. So the blue line maps the non-recessionary trajectory of the Fed funds cutting cycle based on history. And you can see, which you may expect, that if we don't have a recession, the Fed typically doesn't cut as much. And if you go all the way to the bottom here, you typically see the Fed cutting more, much more than expected, than is currently expected if there is, in fact, a recession. So the market's expectations are going to move around. We're going to be taking that into account, as well as the Fed's baseline and how that's shifting around when we're making decisions within the portfolios. But we thought that would be a little bit of context so you can understand what we're thinking about as we navigate. As we move over to the right slide here, basically this takes the Fed funds rate minus the underlying inflation rate measured by the PCE, which is the Fed's preferred gauge. So this goes all the way back to the 80s, and you can see that when it was high, this basically means that the Fed funds rate was much higher than the underlying rate of inflation. So you can think about that as tight policy. So back in the 80s, we were pretty tight. We were almost 6% higher than the inflation rate. And this trended much lower till we got to very, very easy policy in 2020. Obviously, we had a sharp reversal here as the Fed was hiking rates and finally got it above the inflation rate. So we're back to a pretty tight policy stance by the Fed. What you see with this little curve lower is basically the market and the Fed expectation from the left kind of mapped over here. So what we're looking at is both the market and the Fed expect this to come down so we get to a little bit more of a neutral policy stance. So they're not really easing to really juice the economy, but more we're proceeding towards a more normalization here. So this is just a little bit of context. Obviously, how the economy unfolds, how inflation comes in is going to be impacting it all. But it's just one of the things that we're looking at, again, as we're navigating and figuring out which types of bonds we want to have in the portfolio. So this is a monetary side of things, monetary policy. Obviously, with the elections coming up, the fiscal side can be a little bit more impacted by the results of the election. So for a little look at how that's unfolding, I'll turn it back over to Tom.
Great. Thanks, Matt. So you can see from the slide here titled Election Update, I think the theme, the takeaway is it's too close to call. We're only a number of days out and things are still razor thin in terms of margins. In fact, if you look at what we did here was we compared the current polling data versus 2020 and 2016. And on the top in bold is the national, that's the overall average. Right now, the Real Clear Politics average has former President Trump up 0.4%. So obviously well within the margin of error. And it's actually moved back and forth between Harris and Trump over the past few weeks. And by contrast, if you look at 2020, at this time, President Biden was up by 7.9%, and Hillary Clinton in 2016 was up by 4.3%. And we know both of those elections ended in very, very tight election outcomes. So that would be the expectation here. As you look at some of these, what we call swing states, there are 5 of those that are actually 1% or less, whether it be Trump or Harris ahead, which again, that's well within the margin of error. So it's not really predictive of a win on either side. So clearly, this is a very tight election. The same thing stands to reason in the Senate and the House. In fact, in the Senate, we're likely to see maybe a 2 to 3 seat move, depending on a couple of the states that are also the Senate races are very close in those swing states like Wisconsin and Michigan and Pennsylvania. So the outcome is likely to end up with a very tight majority, whoever has it. And in the House of Representatives, there's 435 races, of which the Cook Political Report, which is really the expert on the House of Representative races, has about 25 seats that are considered toss-ups. Only 5.7% of the overall seats that are up for grabs would be considered toss-ups. And they're almost split evenly between Democratic and Republican. So the likely outlook in the House as well is that it typically follows the direction of the White House race, but the governing majority is going to be very, very tight. So the outcome here is likely to be very, very tight and difficult to call. So how do we think through that from a portfolio perspective? If you look at the next page, almost under any circumstance, whether it be a Republican president with divided Congress or Republican Congress or a Democratic Congress, which is fairly rare, or vice versa, you tend to get on an annual basis double-digit returns in the market. This is the S&P return annualized since 1934. And with only a couple of extreme exceptions, you're seeing double-digit returns. And in 4 of the 6 scenarios, almost identical annualized returns. So while elections have significant implications when it comes to the overall market in aggregate, it tends to be less impactful. Where it really makes a difference or can make a difference is in policy implications. And for that, I'm going to turn it over to Jiorden to discuss.
Thanks, Tom. So to your point, we're not really trying to say the election is unimportant, as the resulting policies can create opportunities at the security level within the market. The next couple of slides, which will be covered by Matt and I, provide some examples of how policy implications vary by security, creating some winners and losers. We'll start off with tax policy, which has certainly been an area of discussion in this election, as the direction of corporate taxes obviously has implications for, the earnings generated by certain stocks. So if we just look at Exhibit 9 on the left side of this slide, it takes us back to the 2017 Tax Cuts and Jobs Act, which was the last major tax legislation, and also which is the last major tax legislation, and it specifically reduced the corporate tax rate to 21% from 35%. The exhibit shows the standalone earnings impact from those lower tax rates. It shows it by sector and for the overall market. So here's what we see. For the S&P 500 overall, there was about a 9% uplift to earnings. That impact, however, did specifically vary by sector. As you can see, utilities and staples saw more like a 15% upside, whereas healthcare stocks and energy stocks only saw a 3% upside. This is simply an illustrative example as how tax policy eventually evolves is just one of the policy implications we'll be looking at. So for example, how tax cuts are funded or how tax increases are spent would drive another set of potential winners and losers as well. But this at least gives you a quick view as to how any sort of policy implication really does impact different parts of the markets differently. So another cross current to consider is monetary policy, as the direction of interest rates does impact stock valuations. As Matt alluded to earlier, we have just entered a rate cutting cycle with the Fed guiding to lower rates through the end of 2026. With Fed Chair Powell's term not up until 2026, however, it's probably more the economy and less the election that will influence whether current rate expectations are actually met. Exhibit 10 takes us back to the last time there was a significant change in Fed policy. It was in 2022 when the Fed was hiking the Fed funds rate to combat inflation. And during that time, the Fed funds rate basically went from about 0% to 5.5%. So a pretty significant move. It shows in that exhibit the standalone impact from higher interest rates on stocks. And what we see here is, higher interest rates make fixed income more competitive, and that in turn reduces the multiples investors are willing to sign on any particular stock. And so what you end up seeing here is during that time frame, the S&P 500 saw its multiple decline by about 12%. That drag did vary by underlying category, though. And you can see that, on the low end, you saw large cap value stocks only see their multiples decline by about 10%, whereas on the other side, the extreme side, you saw small cap growth stocks see their multiples decline by about 50% or half. So once again, much like with tax policy, monetary policy does have implications for the market in some form, but there are more significant moves underneath the surface. And so these two exhibits really just provide recent examples of how we would look through winners and losers as future policy evolves as a result of this election. From here, I'll just turn it over to Matt for a similar slide on fixed income. Thanks.
Thanks, Jiorden. Turning over to the bond side, I thought I might show another recent example of a change in monetary policy, and this time it's an example of when the Fed was cutting rates instead of when the Fed was hiking rates. So the most recent relevant time period for this I found to be the second half of 2019, where the economy was slowing, but we weren't in a terrible situation, and the Fed was modestly cutting rates. So what you can see here on the left is that different bond types were impacted differently from these cuts in rates. So similar to Jordan's points, there's winners and losers there. And in the case of bonds, it was mostly winners to different degrees. So you see here, the Fed funds rate was cut by 75 basis points. So that mostly helped the shorter term securities to have their yield decline that much. And if you look at the 10-year Treasury, even though the Fed cut 3 times, a certain amount of that was already expected. So you only saw the 10-year Treasury yield decline by 10 basis points. Moving over to different bond types, there were also winners and losers there. So you could see one of the biggest beneficiaries was high yield, where credit spreads actually declined. So the amount of additional compensation required to buy a high yield bond declined, resulting in outperformance of the riskier areas of the market. So it all seems fairly logical where the Fed's moving to become more accommodative. It lowers interest rates and supports the market that way. So another example of how policy can impact bonds is looking at municipals. Municipals are interesting because the monetary side, which is going to impact interest rates more, mixes with tax policy, where if tax rates are changing, that impacts the relative attractiveness of tax-free municipal bonds. So this chart really tries to show us here that if tax rates increase, in generally speaking, municipal bonds become more attractive. Similarly, if interest rates decline, municipal bonds become more attractive too. So there's really different outcomes. If we moved into an environment where interest rates were rising and tax rates weren't going up, that would be the bear case for municipals, and you'd see that with the negative 4.4 decline in our illustrative example. The other side of it, if interest rates drop and tax rates increase, we'd expect investors to move into municipals, and you'd see the appreciation there. So there's quite a change between the outcomes, and basically it just goes to show you that keeping our eyes open, seeing what the market's expecting, and weighing that against what's likely to happen provides opportunities for us, and that's where we try to add value for your portfolios. So that's about it on the investment side for us. For some closing remarks, I'll turn it back over to Tom.
Thanks, Matt, and thanks, Jordan. As you can see, there's a lot of information that we're parsing through, and things like elections and economies and Fed policy. The team will continue to work hard on working through these different factors in managing portfolios. But now we're heading close to year end. It's an opportunity to do some planning, whether it be tax planning, Social Security planning. As an FYI, the cost of living adjustment for Social Security is going to go up 2.5% in 2025. So if you want to learn more about that or any other matter related to your accounts, please feel free to call your United advisor. They stand ready to help. And we appreciate your time, and we look forward to speaking to you guys again in the near future. Thank you.